Hi, it's Mike Lynch with AmeriFirst Financial. It's Monday morning and it's time for your Monday morning mortgage update for the week of September the 13th. Hope everybody had a great weekend. I had a pretty good weekend. Actually got out and rode my mountain bike with my dog Boss. What a great mountain bike dog he is. Just stays to the side of the trail. A little smoky out on the west side, but you know what? It was good enough to get a good ride in. So what happened last week and what are we looking at this week? Last week, not much happened again. We've been trading on the mortgage-backed securities market in this flat channel and really haven't seen rates go up or down for the past 3 weeks. Now, there's been volatility in those weeks, but we're ending the week the same as we're starting, and then the same thing happened last week. Even with increased inflation numbers, and then we have the COVID fears and all that other stuff, just nothing's happening. Nobody wants to change those rates. The market doesn't. So what are we looking at this week? Really only two things this week: inflation and retail sales that's going to possibly affect rates. So let's talk about inflation. Why is inflation bad for mortgage rates? Well, when people invest their money, they put it basically into two places. They put it in the safer bond market or the riskier stock market. And when they're fearful, when they have concerns, they're going to shift their money from the riskier stock market into the safer bond market. And when there's increased trading in the bond market, mortgage rates go down. Well, since March of last year, the Fed has been buying billions of dollars a week in mortgage-backed securities to artificially keep mortgage rates down. Well, one of the killers of rates is inflation. Even if people are buying rates, even if the free market, your 401ks, your investors, foreign investors are buying those mortgage-backed securities, inflation will cause these rates to go up. Why is that? Well, let's say that you have $1 million in bonds at a 4% rate or yield, and the inflation is 1%. That means you have a 3% rate of return. Now, if inflation goes up to 3% and you still have that 4% bond or 4% yield on that $1 million bond, now you're getting a 1% rate of return. So when we see inflation go up so that investors get their rate of return, we see the yield in bonds go up or the rate in a bond goes up to keep that rate of return, and that causes rates to go up. So inflation, again, is not a very good friend of rates. And a lot of people are stating, the Fed mostly, that inflation that we've been seeing a wage inflation, prices go up, gas inflation, materials inflation. We see size inflation. Your toilet paper rolls are smaller than they used to be, but they cost the same amount. That type of inflation comes in a lot of different ways. And a lot of people think it's temporary, but there's also a growing population that thinks it's here to stay. Now, businesses think inflation is here to stay. They don't think these prices or the supply or the quantity of the materials they make is going to come down. But the Fed, the Federal Reserve, which has an impact on rates, thinks it's temporary. So there's just two sides of the aisle here. The ones that think inflation is temporary thinks that, well, this is all because of the supply chain. This is going to correct itself in 1 or 2 years. We know the supply chain has been disrupted because people can't get back to work, or those that can get back to work are choosing not to. Businesses are having trouble hiring people. Foreign countries like China are having trouble making stuff. We know that automobile or inventory is low. Anything that has to do with microchips or computer parts is that inventory is low because they can't make the stuff. They can't get the stuff through the supply chains. And it's not a problem that corrects itself overnight. It takes time. Now, some people think that we're going to be into this inflationary period for some time because one of the reasons is wage inflation. Wages are going up, and that typically doesn't go back down. Once they stay up, they're going to go up, and that cost can be passed on to the consumer, and that is a cause of inflation. So last week we had the PPI, Producers Price Index report, came out on Friday. Inflation was up, way up actually, but it really didn't move the market. This week, on Tuesday, tomorrow, the CPI, the Consumer Price Index, comes out, another key measure of inflation. We expect it to go up, but is it going to have an impact on the market? Depends if it hits estimates or not. If it's below estimates, probably won't have an impact, but if it's above estimates, definitely could move those mortgage rates up. All right, second thing is retail sales. So retail sales typically have a big impact on the market because if businesses are selling stuff, that means the economy is doing well, and that means money will flow out of the bond market into the riskier stock market. Everybody feels great about things, but it's been down for the last 2 months, and it was down last week. One of the main reasons is the automobile industry isn't selling as many cars. And it's not because there isn't a demand, it's because they can't get the supplies to finish the cars. Again, I talked about that supply chain interruption. Many big companies think that those increased costs, increased prices because of the supply chain really are going to be permanent and are here to stay. And that could affect retail sales. If costs are up, people are going to buy less stuff if there's not the demand for it. So what are we looking at this week? There's really no news this week, nothing besides the CPI coming out tomorrow that can impact rates. We are starting the week floating. We expect a flat week. We expect it to end the same way we started just because there's not much things that could really move the market. So floating, continuing that for the rest of the week. Obviously, we'll watch the CPI tomorrow. If you or your clients need any advice on mortgage rates, how to price out rates, please let me know. If you know somebody who could benefit from this video, please forward it. And if you have any comments, please leave them down below. I'd love to hear back from you. Have a wonderful and productive week. We'll talk to you next week. Bye-bye.